Managing economist at the Center for Economics and Business Research, is joining us now. Josie, you believe the move today will be 50 basis points. That is what the market expectation is as well. How high, though, are the odds that they only go 25, and what does that do to their credibility?
Yeah, so we're expecting a 50 basis point rise, which would be the first one in a long time. So far in the past year, we've just been seeing small increments, usually of 25 basis points. So it could stick to that and just have a 25 basis point rise. Similarly, we might see slightly more aggression with a 75 basis point rise to match the Fed, for instance, last week. And so it's hard to say what they've decided and what will be announced at 12 o'clock today, but most people are expecting that 50 basis point rise. And that's to do, of course, with the fact that inflation is so high at the moment. We saw 9.4% CPI in the latest data, which is nearly 5 times the target rate of 2% CPI inflation. So they have got to be slightly more aggressive than they have been to try and stop that acceleration we've seen over many of the last months in inflation. There is also, the factor of the other central banks, the ECB and the Fed, have both recently made 50 basis point or 75 basis point increases in their base rates. And so international exchange rates are heavily impacted at the moment by these changes in central bank interest rates. And if the Bank of England disappointed markets today with a 25 basis point rise, then there would be implications on the pound. And so that is something that the Bank of England will have been considering.
Okay, of course, and that has impacts for imported energy costs and for other imports as well. Josie, yes, 25 basis points just really would look pedestrian, wouldn't it, in the global context, given what we've seen elsewhere. So we're going to hear about whether it's 50, whether it's 25 today on the rate side. But we're also going to get new forecasts from the Bank of England, and this is going to be interesting, both in terms of just how high does the BOE expect inflation to go, how high into double digits, because I believe we're there already in estimate terms. And then how weak do they expect the economy to get? Will they actually go so far as to forecast a recession is one question.
Yeah, so what we're expecting is a peak of 12% inflation in October. In the UK, we're heavily impacted by changes in the Ofgem energy price cap, which will rise considerably in October. Estimates are of about a 70% rise, which will have dramatic impacts on inflation. And of course, the Bank of England will have recognised that too, and will be expecting inflation to continue to step up, particularly in the autumn and the winter. I wouldn't be surprised if they also start forecasting a technical recession. They were previously forecasting a contraction in Q2, which now looks very unlikely, but we're forecasting a contraction in Q3 and Q4. The UK economy in terms of GDP does seem to be trundling along at the moment with positive growth in all the data that's come out. But the cost of living crisis will start to bite at some point. And that will have implications on growth as consumers cut back on their spending due to this high rate of inflation that we're seeing.
And Josie, what would separate the recession that you're forecasting, a technical one, from what would be a fully blown recession? Why would you call it technical? Is it all in the labour market? Because here in the UK, just as in the US, we still have a very tight labour market story.
Exactly. It's an interesting economy at the moment with this very tight labour market, with the unemployment rate standing at quite a low rate. And so we're not expecting a dramatic rise in unemployment, even if we see these 2 quarters of contraction. But in terms of the economy, we're not expecting a dramatic contraction by any means. We're expecting slow growth this year of around 3.3% over the whole of the year, which we've actually recently upgraded due to resilience in the past few months of data that have come out. And so it's not going to be a whole year of contraction. We're also forecasting weak growth for next year of only about a 0.5% rise over the whole of 2023. But again, that's not a contraction over the whole year. And so while we might see some quarters of contraction, it's not expected to be a prolonged period of downturn. And so that's why it's not going to be a fully blown recession, as you said.
And we see financial conditions have loosened up a lot in the UK. FCON Go on the Bloomberg is an easy way to gauge that. Plus, you have so many hawks on the Bank of England, only a couple of slightly dovish members. Why on earth are they only going to get up to 175? I mean, why aren't they at 3.5?
Yeah, of course. I mean, to get a grip on inflation, much higher interest rates would probably technically be needed. But it's this factor that they probably are forecasting, and we'll see later today, at least 1 quarter of contraction, if not 2. And so they've got to balance the labour market and growth in the economy with inflation. And of course, inflation, we've talked a lot about this, in the UK at the moment, is predominantly supply side driven rather than rapid demand, which is increasing prices. It's the factors of supply chain issues and of course the war in Ukraine, which is having implications on energy prices and food prices. And so there's a question of how much can interest rates, which are a demand lever, affect these supply issues.
Josie, how do you measure that? I mean, we all hear the supply side problems in the news every day, but nominal growth is so high. Demand seems incredibly strong. Isn't that a huge part of it? How do you differentiate the drivers of inflation?
It's tricky to do, and I think we know that there are big supply impacts because we can see, of course, the change in Brent crude oil prices and gas pump prices at energy pumps. And we can see factors such as shipping costs and shipping times that have been incredibly slow, and that naturally increases costs for businesses, which is what they're saying in surveys. And of course, we can look at producer price inflation, so the costs that producers and service inflation as well that companies are facing, which is increasing at a much more rapid pace than consumer price inflation. So we know that businesses are facing higher costs, and they're predominantly import costs. Yeah. But as I mentioned, so far actually, this year in the UK, we have seen quite resilient growth. We haven't seen much in the way of a contraction. So there is some demand that's trundling along, but there is also a cost of living crisis, and people are experiencing real wage cuts. They're struggling to pay for all the goods that they need. And so that will be weakening demand, not strengthening it.
Well, but Josie, to the point on higher costs that people are facing and weakening sentiment, that raises the question of the fiscal response. And Liz Truss, who seems to be gaining momentum, would like to cut taxes. How does the BOE think about that?
Well, there are several elements there. So, of course, if we cut taxes, people are saying there could potentially be an inflationary response, which does make sense. If people have more money to spend, they can go out and buy more things, which creates more demand, and we might see higher prices. We do think there is some room for tax cuts, but there is, of course, a limit in terms of how much you can do without stoking more inflation. So there's a fine balance there. Some things, such as more targeted tax cuts, of course, perhaps a fuel duty cut might be a good thing to consider given the current high rates of petrol at the pump. And so there is some room for tax cuts, but they've got to be balanced with the inflationary impacts.
Josie, thanks very much. Thanks for joining us. Josie Dent of the Centre for Economics and Business Research. Coming up on this programme then, Europe's energy crunch in focus. We will discuss how it is becoming ever more acute. Can nuclear power help fill the gap? We've talked about that this week. There are also questions about the extent that coal might be in trouble now. More on that next. This is Bloomberg.
reliability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center. Bus and Bill.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Scorching temperatures are adding to Europe's energy crisis. France says it will likely extend pauses to its nuclear generation capacity. That's as high river temperatures continue to make it difficult to cool down nuclear reactors. Joining us now, Rachel Morrison, Bloomberg editor for power, gas and renewables in Europe. So the perfect voice to have on this subject, which gets ever more complex then, Rachel, when it comes to the headwinds that the European economy is facing. Let's focus on the nuclear issues. So it's higher river temperatures specifically then that make life difficult for the likes of EDF.
Yes, in France we have more than half of nuclear capacity offline. Some of that is extra checks that EDF has had to do on the fleet, but we are seeing some extra cuts coming from nuclear stations along two rivers which use the water to cool them. And because of high river temperatures, they're limited in how much water they can return to the rivers, so they're having to cut output at a time when really Europe needs as much electricity produced not from coal or gas as it can get.
Yeah, Rachel, to me this story is amazing because it looked for so long like Germany had made the biggest mistake in relying on Russia for gas, and the French were geniuses for continuing to get electricity from nuclear power. Now the French are in so much trouble that the Germans are considering letting their nuclear reactors run longer in order to supply their neighbors with energy. Do you think that's going to help?
Yes, it's been such a huge issue in Germany, that nuclear phase out, and the rhetoric is starting to change with the government sort of making some noises saying that they're considering keeping 3 stations online beyond the end of the year when they're supposed to shut. But really that needs a decision soon because there's fuel supply to secure, maintenance to do, staff to pay to make sure that it can happen. So we understand the government are looking at a sort of stress test to see if that's possible. But yes, at the moment, France needs extra imports from places like Germany, from the UK, from Spain. And so with that extra demand coming from France, which usually exports power to everybody, it looks like there's going to be even more supplies needed from things like nuclear in other countries.
So, Rachel, is that what this comes down to, just searching elsewhere for supply rather than trying to react on the demand side? I mean, where are we in reducing demand in Europe as they had proposed with natural gas?
Germany has made some steps towards that. Of course, in summer, there are limits to what demand you can reduce because people aren't really using their heating. The lights don't go on until later in the evening. So there were some comments by the regulator today which talked about a sort of 5% decrease in demand, and really Germany needs to be more like 10%. So as we get into winter, that pressure will increase. And of course, throughout Europe, we're going to need to see that. The UK is sort of lagging behind somewhat in that energy efficiency drive, but as the temperatures start to cool, we expect those kind of campaigns by governments to pick up pace.
Yeah, we're certainly hearing more and more on that front, aren't we? And it's interesting that the warm river water is the issue in France, low river levels, also now an issue in Germany and for Uniper. Rachel, thank you very much for bringing us the latest on the energy space in Europe. Rachel Morrison with details there. Coming up on the programme, Guggenheim's Scott Minerd takes stock of his investing career and his biggest money mistakes. More on that shortly. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com. This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. And, well, we've all made money mistakes, but behind each blunder is a lesson learned. In a new online series, Bloomberg Quick Take Scarlett Fu speaks with money managers and other leaders in business to hear their big money mistake. In this edition, she sits down with Scott Minerd, Guggenheim Partners Global CIO. Here's part of their conversation.
I was working for Price Waterhouse. It was 1980, and real estate prices had been skyrocketing in Florida. And so I wanted to get in on the real estate boom. I managed to scrape together everything I had, and I found this condominium that I could just get into. I bought it.
How much were the interest rates?
At that time, I got a special subsidized mortgage, which was 9 7/8%.
Ooh.
Right.
When did you realize that it was a mistake?
Well, you mean fully a mistake?
Yeah.
Because it was about a week after closing, I started to have second thoughts. I began to realize, as prices began to soften and decline and sales were going in.
What was the listing price?
It was I think it was $54,750. You remember this when you suffered through something.
That's very exact. And you said your monthly payment on the mortgage was?
It was about $600.
And your annual salary at the time was only
$15,000.
Okay.
That was the mortgage and taxes. I started to feel like a captive. It wasn't like, you know, if I decided I wanted to change jobs or move somewhere, I was tied down with this property.
How did you extricate yourself from this real estate investment in Florida? Like, how does it end with a happy story?
No.
No.
It was actually probably around 2002, 2003, I finally sold it at a loss.
2002, 2003, this is after you retired, unretired, came back to work at Guggenheim, was leading the firm. That's when you sold the apartment at a loss?
Right. Well, it's going to come back.
Wow. Did you make a phone call to anyone about this? I mean, did you tell anyone about this experience, or were you? No,
I was hiding.
You were hiding?
Well, I was embarrassed. You know, my family saw me do this. Everybody saw me do this, and I'd actually gone to my grandparents to get some of the down payment.
Is this something you think you could have learned from a textbook or from someone telling you, or did you have to experience it firsthand yourself?
It taught me a lot about the usefulness of history, because Florida, South Florida in particular, is notorious for real estate booms and busts going back to the 20s. And so, you know, it probably affected the way I looked at all investments going forward, which was not to just listen to the conventional wisdom of what everybody else was saying, but to take what they were saying and, you know, actually, you know, really in reality challenge it.
That was Scott Meinert of Guggenheim Partners sharing his big money mistake with Quick Takes Scarlet Fu. You can catch their full conversation on Bloomberg Quick Takes Twitter account. And Matt, I got to be honest, while we're talking money mistakes and he's talking about the high rate he was paying, and I am planning to buy a car after work today. At least that was my plan. It's probably not the ideal time. It very well may be marking the peak in used car prices, and rates aren't exactly as favorable. So now I'm questioning.
Well, I think you should still go through with it. But you know, while he was talking, I was thinking my big money mistake may have been a few months ago when I bought a house in Westchester at the absolute top of the market. Fortunately, I locked in a much lower rate. But you know, you never know.
That was sensible. It's okay, Kaylee. I don't think you buy used cars for their resale value anyway. So, you know, even if we've hit the peak, maybe that's okay. And maybe it's more sensible to buy the used version, because I don't know, Matt, how long have you been waiting for the new one?
Yeah, I've been waiting about 7 months now, but I know my truck is finally on the way. I've heard it's on a train en route to
well, this
to
is
New York.
exciting.
Yeah.
The very important message I took away from that really nice piece by Scarlet Fu with Scott Meinert is just be really careful if you borrow from your grandparents, because it just comes with a whole load of emotion, it seems. That is it for Early Edition. More surveillance is ahead with Tom, John and Lisa. We will hear from two former Bank of England officials. Jennifer McKeown and Danny Blanchflower join the team. Lots to say in the run-up to that Bank of England news due in an hour or so. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
They don't want recession, but they do need things to slow down for inflation to continue to go lower.
Fed's got a lot of work yet to do. And we think inflation is going to be running still at 4+.
What I worry is on the other side, that the Fed works too fast and too much.
I think that the big issue we have in the market is that the Fed is not about to pivot.
We have right now about a 50-50 chance in terms of tipping over into a true recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive again, up 0.1% on the S&P. TK, we have ripped off the June lows.
We come off the June lows and it's within an August gloom. John, I'm absolutely overwhelmed, from hedge funds to what we heard from Linda Dissel yesterday at Federated. The caution out there, the reticence to believe in this equity rally, to start strong this hour with Howard Ward is wonderful. And within that, John, look at the news flow this morning going to Governor Bailey's, 7 a.m.
Looking ahead to that rate hike, potentially 50 basis points coming up in about an hour from now. Tom, for me, it's not a wall of worry. It's a wall of doubt. I'm with you. Every single percentage point rally, there is just note after note saying, nope, fade this, nope, fade this. Tom, we're 19% higher off the lows on the NASDAQ 100, up more than 13% off the lows on the S&P.
I mean, I had my intern write the banner in August gloom. Let's do it again on radio. John says it better. It's an August doubt. I like that.
A big
wall of doubt. It's a doubt. We're very doubty.
The Fed officials have done, Lisa, exactly what we anticipated they would do, and it's driven yields higher at the front end. Curves inverted even more.
Look at the inversion.
The equity market, though, is not paying any attention to that, seemingly, Bramo, over the last couple of days.
Well, here's the conundrum that I'm wondering about. As you talk about the doubt, there is a doubt about the fundamentals that are driving that lower end of rate picture lower, but there is belief that the Fed is going to ultimately come to the rescue of this market, that is still embedded in this market, that eventually there will be rate cuts. I was reading TD Securities last night. Likely the expectation that quantitative tightening will stop next year, in addition to rate cuts. This still is the belief embedded in markets.
When you say TD, we hear Priya Misra.
Exactly.
Priya Misra, Lisa, looking for negative 40 basis points on 2s10s. Here we are. I mean, we're basically there, aren't we?
And when we take a look, Jeff Gundlach was saying, rough road ahead. He tweeted out this accelerating decline and this accelerating inversion, that 210 spread. How much does that indicate recession? It has most of the time. Now people are saying, well, we're already beyond that. How much is the belief and the lack of doubt that you're seeing in the price action really reflecting the backdrop of easier financial conditions led by the Fed?
Have you called it, Tom? Call of the summer?
Yeah, I think Priya's call is a call of the summer. I went back, John. I looked, did some fancy mathematics. I'm not going to bore you with it's No Math Thursday. Let's be clear on that. But John, I looked at how fast we've inverted, and it's literally a Volcker equivalent. We've moved 170, 180 basis points down, down, down through zero into inversion, and it really harkens back to what we saw off near the crash of 87 into the Volcker 89.
The deepest inversion since the early 2000s. We'll build on that story for you a little bit later this hour. Futures right now, your price action shaping up as follows. Positive 0.2% on the S&P and the Nasdaq 100, up 0.25%. The lift continues. Yields bounce back at the long end. 10-year yields higher by a couple of basis points to 270, 246. And crude, just about holding on to the 90s here, Lisa. 91.57 at 1%.
I don't understand the crude picture. We'll dig into that based on what we got yesterday from OPEC Plus, and then what we got out of the U.S. showing a decline in demand, a really mixed picture there, which we will look into further. What we're looking at today is in about an hour time, the Bank of England is expected to raise rates by the most in 27 years, following the 50 basis point trend that we have seen around the world as a minimum rate hike for the developed world. How much does this indicate the necessity of hiking rates into a weakening economy? I'm watching the pound. We have seen it completely weaken versus the dollar. How much further does that have to go? At what point do outsized rate hikes edify a currency versus weaken it further because it only undermines the economic trajectory even further? This is the conundrum facing the Fed. This is the conundrum even more facing the ECB. At 8:30 a.m., we get U.S. initial jobless claims. We have seen them start to tick up just very, very slowly from near record lows. At what point will this be the sign that people are looking for, that perhaps the Fed will take their foot off the brakes? At what point are people going to see this as strength if it stays at this flatline kind of level? Strength giving support to this idea that the Fed needs to go a lot further. How much does that challenge not just the doubt in the market right now, but the opposite, the strength that we're seeing despite all of that doubt, John, that you were talking about? Today we get a slew of earnings: Lyft, Expedia, TripAdvisor, AMC Entertainment, Live Nation. All of these are interesting to watch for consumer discretionary spending. We've seen a really mixed picture, and we will continue to. How much do we sense, yes, companies adapting and adjusting, but forecasting an ongoing weakening in the backdrop of consumers?
Resilience, the takeaway of the last couple of weeks. Lisa, thank you. Joining us now is Howard Ward, CIO of Growth Equities and Gabelli Funds. Howard, I've got to ask you straight up, how durable do you think this rip-roaring rally is?
Well, we don't know, Jonathan, and that's the whole point. Investors don't know exactly how this script is going to play out. But if you don't believe in market timing, and history has shown that market timing is a loser's game, and I would challenge you to give me a list of the greatest investors of all time that have been market timers, because it would be a pretty short one. We don't know. What we do know is that a lot of stock prices are down 20, 30, 40, 50%, and therein is opportunity. And we're going through a period where the economy appears to be weakening further. We may or may not be in a recession, but recessions tend to be short-term phases in the history of time, and they've always been opportunities for investors to redeploy cash or to upgrade their portfolio by way of stock selection. I don't think this is at any different time, and so I think the current, concerns about interest rates, we have to go back. Interest rates are still historically low. In the 1990s, which was one of the best decades for stock prices, the 10-year Treasury averaged more than 5% and was at higher than 6% towards the end of that period. And the earnings yield on stocks was well below the Treasury yield, sort of like a 3% earnings yield versus a 5 to 6% Treasury yield. The situation's completely inverted today. The earnings yield on stocks is 5 or 6%, and the bond yields are 3%. So there's some margin there for interest rates to go up and for earnings to go down. And stocks are still going to look, I think, historically attractive in terms of their pricing. So I think it's time for investors to realize that we don't really know what's going to happen. We know market timing doesn't work. Stock prices are down. Take advantage of it.
Howard, it's a Howard Ward August, and by that I mean all I'm hearing is the word quality. Everybody's discovered the word you've lived by for decades and decades with Mario, which is quality. Define for our audience on radio and TV this strange word, quality.
Well, Tom, that's a good question. In the world of investing, I think most people view the term quality to refer to a company's balance sheet and its ability to generate free cash, its ability to withstand a recession, difficult times, and that remains very much true today. And in fact, if you went back and looked at studies on stock market components, you'd see that the balance sheet strength is absolutely a trait of outperforming equities during very difficult recessions or bear markets. And so, sure, when we are possibly in a recession, we're in a bear market, quality is important in terms of giving you some protection to the downside, although certainly you're not going to escape unscathed.
I wonder how you feel about European banks right now, Howard. Just getting some news crossing the Bloomberg. This delivered from our team. They're reporting Credit Suisse and their executives are discussing reducing thousands of roles globally as the struggling European lender seeks to slash its overall cost base by an additional $1 billion. TK, there's no macro signal here. There's a Credit Suisse signal here. And let's be clear about that.
Yeah, I agree with that totally. And it's something we're going to see. And we're going right into the season, which is perfect, John. End of the summer, shape it up for Labor Day and on into the autumn in Europe. And it's going to be a right size off 51,000 jobs. I would say 2,000 is normal. 4% or so, John, is completely normal. The question in our reporting is how much more than that, and it seems to be substantial to get to that cost reduction.
That's how much. Let's talk about when. Lisa, expected to finalize its plans over the next couple of months.
Yeah, and this comes after other losses that they have experienced. How do they also keep talent at a time of cuts? We've reported about how much they've had to pay executives to keep them on board amid all the triage, and they're not going to be the last. There's also reports that bonuses are going to come down dramatically this year on Wall Street, in part because of the lack of capital markets activity.
Howard, how long have we talked about the trouble that European banks are finding themselves in? It feels like more than a decade. What's your take on this?
Well, it's been more than a decade because they never really recapitalized properly after 2008-9. And so, one of my funds that I run is the Gabelli Global Growth Fund. We don't own any European banks. Of course, we don't own any domestic banks either. It's not the growthiest place. But in Credit Suisse in particular, what a disaster that stock has been. It's just been one calamity after another. And they've tried to bring in new executives and nothing seems to work. So I don't know what the answer is there. Hopefully they can get their act together at some point. Come on board, do your job.
It's difficult. Howard, thank you. As always, Howard Ward there of Gabelli Funds. That stock intraday up a little more than 2%. Tom, year to date and over the last several years, it's been a struggle for that name.
Yeah, it has as well. I'm doing a compare and contrast with UBS with 71,000 jobs versus the 51,000 at Credit Suisse. And that surprises me. I look at UBS as maybe better run. And so where's that proportional number to Credit Suisse? And my tilt, John, is yes, that's right. It's to a lower number, reduced from 51,000.
Hey, Thomas, the same old question. What do they want to be when they grow up? How many times have we asked that of Credit Suisse? Of other European names too, of Deutsche Bank, etc. Take your pick.
I used to read their securities research a million years ago. Good morning, Mark Flaherty, who was absolutely fabulous on the oil business. And I'd literally look at their font and go, do they understand their font and their securities research is unreadable? I mean, it's little stuff like that, and it's big stuff like some of the huge errors we've seen recently.
I think there's some bigger stuff than that, Tom.
I think there would be bigger stuff than that.
I don't even think that's the small print.
DLJ, you could read the research. Credit Suisse, you couldn't.
I think that's just one of your complaints.
They don't use Helvetica.
Lisa, I just wonder what David Harrow's thinking right now.
You don't use Helvetica. Yeah, exactly. When do they get out?
Monotype Bembo.
What does he just throw up his hands and say, forget about it?
The patient capital that's been behind that name.
John, the Bank of England uses Monotype Bembo.
Tom, is this your rant of the morning?
This is my font. Yesterday we did Bob Seger. Today we're doing fonts.
There was a great documentary on that.
If anyone would like an advisor to your board, Tom's available. Futures on the S&P up 0.2 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. The Bank of England today is expected to raise interest rates by the most in 27 years. Investors are expecting the first half-point rate hike since 1995, despite risks of a recession. The BOE also will give details of how it plans to reverse some of the $1 trillion in stimulus it pumped into the economy over more than a decade. The US Senate has voted overwhelmingly to add Finland and Sweden to NATO. It's a move aimed at bolstering the military alliance after Russia's invasion of Ukraine. Turkey is still threatening to block the two countries from joining. And there will be another attempt to save the landmark Iran nuclear deal. Diplomats from Iran, the US, and Europe will meet again in Vienna after months of deadlock. The accord fell apart after Donald Trump withdrew 4 years ago and reimposed sanctions on the Iranian economy. That led Iran to step up enrichment of uranium. First half profit at Glencore more than doubled to a record thanks to soaring coal prices. The world's top coal shipper will return an additional $4.45 billion to shareholders in dividends and share buybacks. Glencore has been one of the biggest winners from the global energy crunch. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple fans will likely have to wait a little bit longer than expected to get their hands on Apple's first mixed reality headset to compete with Meta's Oculus. The iPhone maker had planned to reveal the new device as early as this June at WWDC and then release it later this year. But the company has been facing some development challenges related to the device overheating, camera technology, and a new operating system. That means that an intro as early as the end of this year or early next year with a wider consumer release in 2023 is more likely. The headset is planned to have super fast M1 Pro-like chips, immersive audio and speaker technology, and capabilities for media consumption, gaming, and communication. The headset will be pricey, however, and probably cost well north of $1,500. The product will be Apple's first big new bet since the Apple Watch launched 7 years ago, and it should enable an all-new class of applications and a developer ecosystem through an onboard app store. Apple then plans to use WWDC 2023 to engage VR and app developers to write software. The first headset, however, is only the beginning for Apple's ambitions in the space. The company is planning a standalone augmented reality headset as a follow-up later this decade. I'm Mark Gurman. This is Power On.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Big Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The president wanted to see oil prices down, wanted to see gasoline prices at the pump down. That's what we're seeing. And I think what's very remarkable here is that we're seeing that happen while one of the largest oil producers in the world is in the middle of a war in Europe and is under sanctions. So this is not an easy time to manage energy markets.
You can say that again. That was Amos Hochstein there, the senior advisor for energy security at the U.S. Department of State from New York City this morning. Good morning. Here's the price action adding to yesterday's really solid gains in the equity market. On the S&P up by around about 0.25% on the S&P. On the NASDAQ 100 up 0.4%. Really strong rally that Max Kettner of HSBC calls wishful thinking.
Wow, what a
this
note.
Morning. He does, though, and I appreciate this. At the end of the note, he says, where could we be wrong? I have a lot of time for that. And he goes on to say, Tom, if inflation does indeed surprise to the downside or growth stabilizes much more quickly than we thought, then the recent rally in growth over value could continue.
That's where you, at the bottom of research note, you put in your risk factors, and that's well said by Max Kettner. But, John, it's a piercing note from HSBC, and he doesn't mince words. He says you need to be in U.S. dollar cash. Rarely do you see that from a house.
For this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields. But market pricing of risk assets, he goes on to say, Tom, is now very much out of line with our cyclical growth indicators. Tom, I've got a long list of banks now, just pushing back against what
it's
we've
amazing.
seen
It's
over
amazing.
the last month.
And Bloomberg News features Bernstein and someone else this morning is well on this. Let's get to Washington right now. The heat of the summer is extraordinary, and it is wrapped around the always beautiful and dry heat of Arizona, and that would be Senator Sinema. Jack Fitzpatrick joins now with Bloomberg Government to keep score. Jack, it's really moved away from the news on this Thursday morning, but nevertheless, here we are looking at tax analysis. I go to Richard Rubin in the Wall Street Journal, his wonderful, legendary tax work of the worry of corporate taxes filtering down to mere mortal people. Is that the attention of the senator from Arizona who was so important in this debate?
That has gotten some attention, and the argument, especially from Republicans, that this would raise costs to consumers and not just from companies, that is becoming a more significant talking point. I don't know that I can necessarily confirm that is the primary focus of Senator Sinema. For one thing she had never signed off on in this package is the carried interest measure. If that had to come out, it wouldn't necessarily break down the whole thing. It's not a massive amount of revenue, but she has raised some concerns about exactly who the minimum, the 15% corporate minimum tax rate would apply to, and if there are some changes that might be able to be made on deducting investments for the depreciation of assets. I don't know necessarily that the Joint Committee on Taxation's score on this potentially raising costs for everybody else is the primary focus for her, but I do know, one, it's something Republicans are playing up and that you'll hear about on the campaign trail, and it's making a lot of noise.
Yeah.
Two, Sinema really is the person to watch who's been hesitant about increasing taxes overall on corporations. She's got concerns. It doesn't mean she's going to tank the bill, but she has become the big X factor.
Well, just in the movie of the morning, Greg Valliere published this moments ago and says it's too good to be true. What's the calendar here, Jack? I mean, we're distracted with Bank of England, Jobs Day tomorrow, and the rest of it. Should we be focused on this legislation into the weekend, into the Sunday talk shows?
Yeah, we don't know when they're going to move ahead with the process to get this bill across the floor in the Senate, but it's a matter of days. That's the goal.
Okay.
If they hit a big hurdle with Sinema, it could get bumped back, but they want to do this before they leave. They were supposed to leave for their August recess at the end of this week. Now the conversation is, does it happen over the weekend? Does it happen early next week? But if they can get this through, the Senate's going to try to do it in a matter or so. That's what we're hearing for this bill.
Jack, in the meantime, there is a bipartisan effort on Capitol Hill to pass a bill naming Taiwan a major non-NATO ally, which has been the policy for decades in the United States, but not formalized in this manner. And it's put President Biden in this awkward position where he's pushing back and getting some heat for it. Why is it in his interest to push back at a time of heightening concerns about China and bipartisan agreement that the U.S. needs to take a pretty straight line on this?
Yeah, well, the timing may be an issue. It's a sensitive time with Pelosi's trip to Taiwan. You're right that this would formalize a relationship that already exists between the U.S. And Taiwan. There's other stuff in there, but it doesn't seem to be the point of objection. There are a few $1 billion in security aid that is not unusual for the U.S. to send to Taiwan. And that kind of leaves the issue of timing and the sensitivity of communications with China on Pelosi's trip as the likely main culprit. Chris Murphy, a key senator on this, said he has concerns and there might need to be a rewriting, but really for all intents and purposes right now, the White House has kind of pumped the brakes and at least bumped this back until after the August recess. There was supposed to be a committee vote yesterday. They didn't hold that. So it may be a matter of a delay at the request of the White House, because it's not just a fundamental debate over the U.S.'s relationship with Taiwan. It seems to be more a matter of how that plays publicly at this point in time in the context of Speaker Pelosi's trip.
Jack, just quickly, can you clarify for me at least why a Democratic senator would be against closing the carried interest loophole? What's her justification for that?
I think the biggest push against it, one, it wouldn't raise a bunch of money. Two, there are arguments relating to the assumption that those fund managers are profitable in any given year. You may hear more from the fund managers themselves on exactly how this would affect them, but there's some argument over who it is unfair to, in also the context of, in a more than $700 billion bill, this is supposed to raise maybe $14 billion. So it is one of the, arguments aside, it may be one of the slightly less important measures in the bill.
Jack, thank you. Jack Fitzpatrick, thank you very much. Tom, it's not really about the money raised. I guess it was always about fairness for this party.
Well,
and this is something that's not going away. And I think this is the frustration that the Democrats have with Senator Sinema, that on something like this, it should be pretty straightforward.
Right. I mean, John, in the ballet of the British elections, Truss and Sunak and that, I wonder how fair translates. What I know in America is, John, when you hear the word fair, all your radar goes up.
I know, but that word's been used a lot over the last year or so.
To be fair.
To be fair.
Yeah.
Futures up 1/3% from New York City this morning. Good morning to you all. A Bank of England decision 35 minutes away.
the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now, the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK. Have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Equity futures up 1/3%, climbing a wall of doubt. We've talked about that this morning already. Again, on the Nasdaq up 0.5%. The data yesterday, the ISM robust. The S&P Global PMI, not so much, but we're choosing to focus on the good stuff and not the bad stuff. So the equity market ripped yesterday off the back of the ISM, ignoring the S&P Global PMI, which I know Lisa's got a lot of things to say about. And in the bond market, we responded to more hawkish Fed speak. Yields higher again for a third straight session, up 3 basis points at the front end. Your 2-year up by about 3 basis points to 3.1%. We've talked about that inversion. So 2's higher, yesterday 10's lower. Came very, very close to negative 40 basis points. Just today, Tom, you've got to go all the way back to the early 2000s, spring 2000, when we had about negative 56 basis points. We're not a million miles away, TK, on 2's versus 10's.
2's 10's is a huge deal. To me, it's front and center today, John. Currencies have quieted down a little bit. We've got an equity rally, including advancing this morning. I think Howard Ward pushed the market higher. John, 2's 10's is the heart of the debate right now.
Amazing to me, Tom, how few people believe in this rally. With the exception of maybe...
It's an August of doubt.
Maybe Credit Suisse and JP Morgan. Others do not see this playing out very well at all. HSBC, as we discussed moments ago, calling all of this wishful thinking.
Yeah, I think, John, there's some optimism out there, but to be honest, it's being drowned out with the force of the doubt, the force of the gloom.
Resilience in the earnings.
Yeah.
1. I'd say the ISM yesterday, strong, robust. 2, actually picked up. So many nuances here we're trying to work through, Tom. We've got this inventory story, the switch from goods back over to services. I think that's distorting the data in a way that is confusing for many people as well, Tom. And these are difficult moments to work out where we're going here.
And the shock of double-digit inflation, which takes us over to the central bank ballet. Right now, that ballet is on Bank of England. John will be leading our coverage with that here in 29 minutes. Jennifer McCune, right now, former Bank of England economist, head of the Global Economic Service at Capital Economics, will help us here and particularly help me. I want to start with what won't happen, Jennifer. The silence of Governor Bailey. What does he want to avoid talking about this morning?
Well, I'm not sure he'll want to avoid talking about anything specific. Of course, the Bank of England has come under some criticism for not acting faster, for not acting sooner. He'll want to stress that a lot of the rise in inflation has been about the supply side. That there was relatively little that the bank could have done about that, and to avoid further criticism on that front. But I think the key for the bank will be in what it's signalling going forward, what the vote shows us, what the forecasts show us about just how fast the pace of tightening will be in future.
Does he make the decision, Or is there a different structure there than the U.S. Central Bank? I mean, Catherine Mann, as a visitor from America, I believe is very hawkish, and there's others very dovish. Do they matter in the debate, or is this all about Governor Bailey?
Yeah, no, absolutely they matter. There's a vote. And while Governor Bailey will put forward a proposal for what the change should be today, it will be down to the committee at the end of the day. So that those votes will certainly be playing a role, and we think there's likely to be a pretty big shift at this meeting in favour of a 50 basis point hike.
The most important thing to recognise, Tom, when it comes to the Bank of England, say the Federal Reserve, is just the disproportionate importance of bank rate at the Bank of England, Tom, compared to funds rate over the Federal Reserve, because capital markets in the US are so important compared to, say, the UK. I remember when Governor Carney took over, Jennifer, and you'll remember this too, he talked about the importance of bank rate for consumer loans, for corporate loans, and that's very, very different here in America. So can you help me understand, when it comes to the Bank of England, how they push through bank rate just a little bit more, say, compared to, say, capital markets?
Yeah, well, everything's essentially priced off bank rate. It plays a really important role in the UK economy. Mortgages, in particular, are more often at variable rates than they are in the US, and that means that the pass-through from bank rate to those variable rate mortgages in particular, and hence onto households, is pretty significant. So it's very much a live issue, what's going to happen to the policy rate, and people watch it, even in tabloids in the UK, the bank rate is well known, and people generally, I think, know what that rate is, and will be very interested to see whether there is a 50 basis point hike for the first time since the Bank of England's independence.
Given the importance of that rate, why is the Bank of England thinking about outright selling gilt? And they could announce that plan as soon as today.
Yeah, they could do. I think that's much less important than what's going to happen to bank rate. We already knew that the Bank of England's balance sheet was going to be reducing in size over time, because it's allowing assets to mature. There are significant assets maturing, and it's not rolling that over in full. The question now is whether it's going to start actively selling gilts. We might get some indication of that today, but I think there's an assumption that it will do later this year and going into next year. So if it's just backing up that assumption that's already in the market, then I wouldn't expect a major reaction to that.
Jennifer, taking a step back, the Bank of England is uniquely positioned in a moment of pain where central banks are having to raise rates at the fastest pace in decades in the face of economic weakness. Bank of England faces this perhaps more than the Federal Reserve and really is at the epicenter. How do they message this? How do they message what they are going for at a time when the economy is already weakening so substantially that you're seeing it translate into real-time data?
Yeah, I mean, that's absolutely right. It's an extremely difficult position for a central bank to be in. And I think it will have to convey that dilemma between the fact that inflation has been rising very quickly. It's very, very high, even compared to other advanced economies where inflation's also high. And wage growth is rising. We've got pretty strong wage growth in the UK too now. Real concerns about second round effects, and that could lead to significant persistence in inflation. But at the same time, as you say, real weakness in the real economy, real signs that the very high energy prices and the effects of that on real incomes are starting to weigh on spending, and that's really dragging on the economy, and a really big risk that we fall into recession. Actually, we are predicting a technical recession in the UK economy later this year, but at the same time, we think that the Bank of England will continue raising rates to a peak of 3%. So it's likely to come under some criticism for that, but there's little else that it can do with these inflationary pressures.
Jennifer, from your seat when you were at the Bank of England as an economist, can you give us a sense of how important it is to the members on that central bank when they take a look at the pound and how much it has deteriorated versus both the euro as well as the dollar? This is an inflationary force. How do they deal with this? How do they factor this into what they're looking for in their rate decisions?
Yeah, well, it is a factor, and it feeds through mechanically into the Bank of England's inflation forecast. So the inflationary consequences of sterling's movements will be playing a role. But the Bank of England has been very clear always, and even in the recent past, that it doesn't target the exchange rate. It's not an explicit factor, but what will be playing a role is its influence on the inflation outlook and any additional upward pressure that it might be putting on inflation. I think really the labour market is the absolute key, though, and what's happening to wage growth and what businesses, including within the Bank of England's own survey of decision makers, think that they're going to do with wage growth in the future. And at the moment, the worrying evidence is that they intend to raise wage growth further.
Jennifer, great to catch up, especially with someone with experience at the Bank of England and inside those walls. Jennifer Micchione there of Capital Economics. TK, I mentioned that difference between the Bank of England and Fed funds. If you have a variable rate mortgage and that rate goes up, the next month you'll see it. And that's very, very different.
And that's very British. Yeah, let's be clear, John. There's a lot of variable rate mortgages in the United Kingdom, right?
There are many, Tom. And in fact, that worked out through subprime, Tom, and the crisis around that, because if you had a variable rate mortgage back then, it dropped down to close to zero, didn't it? And stayed there for a long time. Yeah, but you had the
6,000 square feet in Notting Hill, so that worked out as well. John, look at the difference in curve inversion. The difference in yield between the 2-year and the 10-year, the massive inversion in the United States, really hearkening back, negative 37 basis points, and the flat line in the United Kingdom of 1 basis point. John, the pros make a real distinction here about deep inversion versus flatline.
And some serious inversion developing here in the United States, Lee. So that's something that you've really got to think about a little bit more.
Well, what you could say is that this is faith that the market has in the Federal Reserve. I mean, you could talk about Fed credibility, but in some ways, this is basically saying the Fed is as credible as ever before, and they're going to get rates back down to that 2% level or below. They're going to get inflation back there, and that is what you're seeing in the long end, even as people ratchet up what the Fed has to do to get there. And to me, that's sort of what the indication here is. They are expecting more work on the front end, which doesn't speak well to the economic outlook. Again, fueling those doubts.
You want to explain this equity market move on the NASDAQ up 0.6 of 1%, on the S&P up 0.4. A Bloomberg subscriber reached out to me, Tom.
Oh, here we go.
Smart individual, and they've got a lot to say about nominal growth and the importance of nominal growth and what that means for earnings.
Well, you know, I'm there.
I know you are. I know you are.
And others, but let me explain that into the timeline of the third quarter into fourth quarter. If you say a resilient nominal growth, at the same time you're saying extended, more persistent inflation. That's sort of the translation of that, John.
I'll pick up on the price section now, Tom. Up around about 0.4 on the S&P, on the NASDAQ, up 0.6. Your bond market, TK's all over.
Dow
it looks like this.
Futures up 94.
It's up a couple of basis points. Thanks for that, Tom. What's that, a third of 1%?
Yeah,
something like that.
I don't keep track of the
It's not what it was 20 years ago, that's for sure. It's a joke, Tom, about points on the Dow. Anyway, whatever. All right. The crude market looks like this, up about 1%, 91.61. What did you make of yesterday, Tom? Demand for gasoline in America. The driving season is not developing in the way that it typically does. People aren't driving.
Come on, it's an historic summer. We all know that. Our kids are bouncing off the walls post-pandemic. All the rules are being broken. Why should we have a repetition of normal times this summer?
Demand destruction, Elisa, is in the data.
Yeah, and that lack of driving, how much is that? What's behind the gas prices? Not the SPR release, not any additional production from anywhere. It's really the demand destruction that you're seeing in real time.
Paul Sankey has things to say, the founder and lead analyst at Sankey Research, joining us very shortly from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. Ukraine's President Volodymyr Zelensky wants direct talks with China's Xi Jinping. Zelensky says that Beijing hasn't replied to Ukraine's requests since the Russian invasion in February. He told the South China Morning Post that China could, quote, put the Russian Federation in a certain place. Bloomberg's learned that Senator Kristen Sinema is seeking to curb corporate taxes and keep a brake for private equity in the Democratic's economic package. The Arizona Democrat will be a pivotal vote. Sinema wants to drop a provision from the bill that would scale back a tax break for fund managers known as carried interest. She also wants to narrow the 15% minimum tax on financial profits. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees, is trying to move back to profitability after both losses and scandals. SoftBank reportedly has raised as much as $22 billion by selling Alibaba derivatives. That's according to the Financial Times. The newspaper says SoftBank sold prepaid forward contracts on Alibaba that allows the Japanese company to raise cash immediately whilst keeping open the possibility of holding on to the shares. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The industry is in an arms race that will lead to spending itself into an oversupply. I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. And it's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
hard to overstate how disappointing this OPEC Plus decision is for the Biden administration. Frankly, it's the geopolitical equivalent of a slap in the face. The Biden administration made a huge miscalculation.
That was Isaac Boltanski, the BTIG Director of Policy Research from New York City this morning. Good morning. Alice Hochstein of the White House pushed back against that summary, that characterization of that decision yesterday. He said it was more than just about oil in Saudi Arabia. Futures right now up 1/3% on the S&P, and the Nasdaq up 0.5%. Yields just a little bit higher too, up 3 basis points to 273. Get a Bank of England decision in 12 minutes time. Then on to data out of the United States a little bit later this morning, 8:30 Eastern, jobless claims. Tom, how much crude is actually out there for OPEC Plus to be pumping? That's the big question.
It's a mystery right now that you see not only in OPEC Plus, but really worldwide. It is a different world after what we've seen, and the bets made by strategists, some saying 120, even 150, maybe a few higher, and others really saying, wait a minute, demand is disappearing. Think $90 a Brent barrel, even down to a whispered 80. Paul Sankey has seen all of this before. On the edge of legendary, the founder and lead analyst at Sankey Research, who writes a strange and twisted note, which is almost Sankey's zeitgeist of what he's seen in earnings. Paul, I want to go to your wheelhouse, which is gaming the capital expenditure culture and belief of the big oil companies, the E&P companies, given CapEx inflation. It's gotten expensive to find the next marginal barrel.
Well, not in the Permian. I mean, I think they know where the oil is in Texas, but what they've stopped doing is spending the money that you're referring to on global exploration or trying to find the next big thing. Now, they have found one next big thing, which is Guyana, but that's just about all that's been significantly discovered over the past decade. And as you say, the expense of finding oil and the uncertainty of finding new oil particularly is really constraining global capacity badly. And then, as you've referred in the program already, OPEC just is out of capacity. I don't see it as a slap in the face from OPEC to the Biden administration. I see it as more of a shrug or a we're powerless move, that they really can't add any capacity. There's only Saudi and UAE that have any spare capacity left. And as was also noted, OPEC actually highlighted that they don't have any spare capacity and they're worried about it. So there's a real problem out there. And if it wasn't for the SPR release, the million barrel a day SPR release, we would be a lot higher.
They're not keeping it a secret. So walk me through things for next year, Paul. If we don't get a recession, if China comes back online, what this commodity market actually looks like, particularly in crude.
Yeah, funny enough, I was thinking about that just this morning, because 2023 does set up, and beyond actually, for very, very strong. Now, the one thing that is notable is that we're seeing weak US gasoline demand, and people are blaming that on government conspiracies and other nonsense. I think the cars are more efficient. If you look at vehicle miles traveled, they're high. So it's not necessarily a change in behavior. What it is a change in the kind of vehicle people are driving. And it's obviously not EVs, electric vehicles. It's just more efficient cars that turn off in traffic jams and everything else. I think that's what we're seeing, combined with marginal behavior change where people are less wasteful with gasoline when it's expensive.
Wait, Paul, are you saying that shift in the type of vehicle has happened in the past 2 years so dramatically? Because what this data showed from the EIA was that the amount of driving over the summer has been less, going back even to 2020 during the peak of the pandemic.
Yeah, you've got me a bit with that one, because the speed of the change does look like there's also marginal behavior change. But I think underlying it is a rolling significant increase in new car efficiency that would have a significant effect at the margin on US gasoline demand. Well, there's a tremendous amount of demand for gasoline in the US that's discretionary. And I think people also just take that one less trip, and everyone tends to behave in the same way. And that's the other effect that we're seeing as a result of high prices.
Paul, are you surprised that the market isn't responding more to the OPEC Plus saying themselves that they're bumping up against the limits of how much they can produce? That previously would have produced a really big response in markets. And it basically was just another thing in the day that got forgotten very quickly.
Yeah, I think it's like the yield curve. I think what you're seeing is the back end of the curve for oil is holding up. I still think it's low. But it is holding up as the front month is coming down. The front month is being attacked by the SPR in a very big way. So I think the big question, as John is highlighting, is what happens when we get China back and then the SPR has to turn off, I think, post the midterms. That really sets up for a very powerful 2023. This tape today, this equity tape, isn't buying 2023. It's buying a short-term bounce, short covering move. And as a result, nobody wants to own an oil company as they see the oil price falling towards turnaround season for the refiners. Turnaround season for the refiners will be the more important demand effect that we see over the coming months. So I'm kind of bearish right now, to be honest with you.
What's your oil price out 1 year? I mean, I'm confused here in that I'm hearing so many cross currents. Are you able to guesstimate Brent a year out?
Well, we had said that we thought you'd see 110 to 150 through summer, so we're losing that. It's tried to hold that level, but has essentially failed. I think it's easy to argue for $100 oil on an ongoing basis starting in 2023. I don't think you'll do much above 150 over time, simply because the demand elasticity, the effect of the strong dollar combined with that kind of oil price will hold you below that level. I'm not a buyer of the 200, 250 type crazy numbers. I just don't think we can sustain that.
Paul, just to be clear, you slipped in the word bearish. Near term, what's the downside?
Bearish? Me? Nobody wants a bearish oil analyst. I think over the next few months, as long as this SPR, which is going to keep coming at 1 million barrels a day, you've got to think that the whole of OPEC just added 100,000, and we're pumping up 1 million a day that the U.S. refiners can't absorb. It's too much for their capacity. They're running at full capacity. So the oil is actually being exported. Now, that is terrible energy security policy. There's no question about that. It's good market policy because they're hammering the oil price. So I think the other way of looking at it is, wow, we're at 90 with 1 million barrels a day of SPR release, which is an all-time historic high. It's a huge number at the margin, to be releasing that much oil on such a sustained basis. And it's going to happen for months more.
Downside, Paul, what's the number?
People are pointing, technical analysts, great chart readers like you, John, are pointing at 80.
Okay. Paul Sankey, thank you. Sankey Research.
That was a great find.
I know. Paul, thank you. Setting the stage for a rally over the next year, though, Tom. Everything that Paul was saying just then is the reason the energy bulls aren't going away anytime soon.
It's not only the construction of a barrel, which Sankey's legendary for, but also his work with Adam Szymanski years ago. And that key word in there, John, elasticities. The translation of that from fancy bow tie talk is responsiveness. What is the responsiveness of demand to that move in price? You heard Mr. Sankey pour some cold water on the 150 plus price guess.
I heard the same thing. In about 5 minutes, we'll bring you the Bank of England rate decision. We'll catch up with Jordan Rochester, the G10 FX strategist over at Nomura. This market, The Economist, looking for something close to 50 basis points from Threadneedle Street. We'll find out if that's what we get in a few minutes' time. Going into it, futures stateside positive, up 1/3 on the S&P, on the Nasdaq up 0.5%. Yields a little bit higher by a couple of basis points, 272.64. With Tom Keane, Elisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
They don't want recession, but they do need things to slow down for inflation to continue to go lower.
Fed's got a lot of work yet to do. And we think inflation is going to be running still at 4+.
What I worry is on the other side, that the Fed works too fast and too much.
I think that the big issue we have in the market is that the Fed is not about to pivot.
We have right now about a 50-50 chance in terms of tipping over into a true recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is the biggest rate hike from the Bank of England in 27 years. Live from New York City this morning. Good morning, with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. This is Bloomberg Surveillance. Futures positive by 0.25% on the S&P. TK, it's 50 from the BOE.
50, and it's a different 50 than the American economy. I really have trouble, John, with the equivalencies of the Fed to the Bank of England. It's two different stories. You're expert at this. I know Lizzie is as well. But the answer is sterling a little bit weaker off this historic moment.
In line with expectations, sterling unmoved off the back of this. Lisa, cable 121.80.
You know, looking at this is again a bank that's having to hike into weakness. How much does this outsized hike give some support to the pound? You are seeing a little bit of support. Is it enough, though, to be disinflationary at a time when that's exactly what they need in the face of incredibly high inflation and not a sign that it's really going to deflate on its own?
The split 8-1. 8 Bank of England officials looking for 50 basis points. Just one looking for a 25 basis point hike. Going through the headlines for us. Outside the Bank of England this morning is Lizzie Burden. Morning, Lizzie.
Morning, Tom.
What's your take on things?
Well, so this is very much in line with expectations. It was well trailed. Andrew Bailey, the governor, had said in his Mansion House speech that 50 basis points were on the table, although he didn't say it was locked in. So this is very much what markets and economists had expected. Obviously, there's lots of international pressure. The Fed and the ECB had gone for jumbo hikes, but it'll hurt consumers. It'll hurt people with mortgages. Rightmove says that the average home for first-time buyers' mortgage payment will rise 5.5% to just over £1,000 a month. So it's going to be much harder for first-time buyers to get on the market at a time when that's really a political priority. You've also seen out of the BOE, the recession forecast is changed. The growth forecasts have changed. So they're now saying that a recession will begin in the fourth quarter and last all the way through next year. Frankly, John, it's a bit meaningless when we're about to get a new Prime Minister in the UK. They're obviously going to do more fiscally. Liz Truss wants to unleash a whole load of tax cuts to the tune of about £30 billion. Yes, that might be inflationary, but surely it will help to cushion the blow in recession terms. The bank's also boosted its forecast for the peak of inflation. So remember, it had seen double-digit inflation in the fall. It's not just that now, it's 13.3% in October, and that reflects the higher energy prices that we're going to see in the fall, but that could be even worse next year. We're going to get the press conference at 12:30. I think that you can definitely expect Andrew Bailey to get a load of questions about the political pressure he's been under recently. The front runner to be the next Prime Minister, Liz Truss, has been particularly scathing on the bank's record, curbing inflation, actually saying that she wants to change the BOE's mandate. But I think Andrew Bailey is probably just going to bat those questions off to the Treasury because it's for them to set the mandate. 13%
inflation in Q4, just brutal. Lizzie, great work. Lizzie Burden this morning outside the Bank of England. We'll hear from Governor Bailey in about 25 minutes' time. Tom, 13% inflation. recession in Q4, the Bank of England hiking 50 basis points. It's pretty toxic stuff. As Lizzie said, though, the fiscal picture not clear just yet.
For our American audience, the heritage of that statistic, John, 13.2%, I can't say enough about that. John, when we go to the United Kingdom, most of us go to what? 3 zones of, we get to Harrods is our farthest west we go. Once every 5 years we go to Bath to have a bath. Other than that, John, the deflation, the harmful deflation of the 30s. It's different over there.
They're getting squeezed, and they're getting squeezed even harder. Looking at the reaction in gilt yields lower at the long end by about 3 basis points, a bit higher at the front end by 3 basis points. Sterling fades a little bit. Cable negative by almost 1/10% now, 121.42. For those of you just tuning in, I'll give you a snapshot of the broader market to get things started stateside. Futures are positive by 0.25% on the S&P 500. On the NASDAQ 100 up by 0.4%. So we're lifting this equity market once again. Yields higher by a couple of basis points, call it 2 basis points higher on treasuries, 272.46, and some curve inversion that we haven't seen for a long, long time, very close to negative 40 basis points. So 50 basis points is the hike from the Bank of England. Standing by, Jordan Rochester, G10 FX strategist over at Nomura. Jordan, your reaction to this decision by the BOE?
Well, John, it's the simple case that this wasn't a big surprise from the Bank of England. We were expecting around 50 basis points. That's what we got today. Conversations with clients as well. 50 basis points from the Bank of England is probably the last 50 basis points from them. It's the first and the last since they became independent, probably. As for us, the view is that the situation in the energy market will decimate the incomes of UK workers. The consumer confidence is going to continue to fall. Consumption is going to continue to slow. And the Bank of England is going to potentially revise down their inflation forecast. So the last rate hike of this cycle is probably going to be November, is the view from us. And that means it's very unclear to me why today the Bank of England doing 50 is a reason to buy the pound. Now, if they did 75, you would have seen sterling head higher. But, John, the problem for markets is we're just not used to trading 1970s style stagflation. Yeah. Tom was mentioning there the 13% inflation really decimating people's ability to spend. The Bank of England will reflect on this. They've already put in their forecast. Today we saw they think the price cap goes up to 3,500 in October. That's about right. It's going up again in January to £3,800 per year for the average household. This is a massive amount of money coming out of the system just spent on energy.
Jordan, I think very much different than the Fed, where we have all the different Fed presidents, including Kansas City, where we'll visit at Jackson Hole. We perceive the Bank of England as the city and maybe London as well. What does 13% inflation do to the Bank of England's relationship with to go to the Premier League this weekend, to Liverpool, to Leicester, to Newcastle? What is the BOE relationship with the inflation the North will face?
Well, indeed, you mentioned, Tom, you haven't ventured past Harrods. So one day me and John will have to take to our hometown, north of Birmingham and Sutton Coldfield. It will be felt a lot in the north. We're seeing lots of strikes being held around the UK. I was listening to one of the NHS union representatives just earlier this week, and the pay rises they're being offered after inflation adjusted, roughly 10% real pay cuts. It's essentially like asking workers to do a whole month of the year working for free or losing all of their statutory holidays. So the impact will be we're going to have more labour market strikes. This will potentially see wages go up. So it puts the Bank of England in a really strange place that they're raising rates. The consumer is being squeezed. That does lower their inflation forecast perhaps ahead. But if we do get a wage price spiral, this is very 1970s like. So they're going to be keeping an eye on that. And the way the Bank of England looks at it in the north, they use the Bank of England agent summary. We've only just got it now, so I'll need to look through those details that came out at the same time as this meeting. But they do get a holistic picture of the rest of the country through the agents, and they will be seeing this story that I've just laid out playing out around the country.
Jordan, I want to dig a little deeper into your idea that November will be the last rate hike. It will be the end of the rate hiking cycle of the Bank of England, raising questions about the front loading of monetary policy and monetary tightening. That has been a big discussion. We have the Bank of England warning of a long recession. At what point does that pause in rate hikes lead to rate cuts, in your view?
It could happen quite quickly. The Bank of England was one of the first major central banks to raise rates. They started in December last year, whilst everyone was still talking about transitory and Omicron. So when the Bank of England kicked things off in December last year, it gives them the sort of the ability to end their rate hiking cycle earlier than most, and also introduce the idea of cuts. So we're looking for May cuts from the Bank of England, that sort of timing. And why? So inflation will still be higher than 2%. I actually think the risk reward is inflation doesn't fall down to 2% as quickly as the market's pricing. But the central banks will react to the situation in credit markets. If you look at the crossover spreads, you look at the ECB systemic risk, whatever you want to look at, the credit stress in the market is roughly around the same levels as the worst moments in the coronavirus panic of March 2020. I suspect the energy prices, 10 times higher than they were on average in Germany, will knock out the business models of many manufacturers. We're going to see credit stress lead to higher defaults, lead to unemployment rising. And that's why in Q4 and Q1, the story will change for central banks. Even though we'll have high inflation, there could be a dovish moment.
Jordan, South Sterling, still the trade for you?
Indeed. I think we've had a big move higher up to the 122 level. Not very fun for me holding a short for about that period, but the trend is lower in sterling. It has the same problems as Europe when it comes to this energy crisis. Its central bank has just done 50 basis points. Look back to the ECB meeting. They did 50 basis points. What did the euro do? Nothing. So just because central banks are doing these big rate hikes, it's not enough to defend their currency against what's a big terms of trade shock. The pound should essentially be trading towards 115 down to 110. Just based on terms of trade alone. The price of the UK's exports have fallen, whilst the price of the UK's imports have skyrocketed. The UK needs a weaker currency to help its exchange rate.
Ugly. Jordan, just quickly, can you imagine if the Fed forecast a recession like this one that starts in 4Q and runs through the whole of next year?
Good point.
Could you see them ever doing that, Jordan?
What we're forecasting.
Could you
it's
imagine?
What we're forecasting at Nomura, so I can see it happening, but they'll be a bit slower than us to get there.
Jordan, I know that's the Nomura call. Jordan Rochester there of Nomura. We'll take TK to Little Aston and not Aston, and that's a snobby joke, Tom, from Birmingham, which you won't get, but Jordan does.
You know, when you tour on, Lisa, help me here. Between Faro and Rochester, I can only understand about one every 4 words.
Really?
Yeah, I mean, it's just lost in translation.
Should do Duolingo for British.
It's like watching Peaky Blinders. I'm like, give me another drink.
Come on, guys,
can't
brutal.
understand him.
I understand it all. I don't think it's brutal.
I know, he's just rude sometimes. That's all. Can you imagine if the Fed forecast this, Lisa?
They would never
forecast starting in 4Q that goes for the whole of next year.
The issue is not the plausibility of that happening. The issue is them saying it out loud. The Fed would never say that out loud. And that, I think, is the distinction.
50 basis point hike by the Bank of England. Sterling weaker by a third of 1%. Yields lower at the long end by 7 basis points on a 10-year. So 2's 10s inverts for the first time since 2019 in the UK on a gilt curve. From New York, still more to come. Lee Ferridge in the next hour from State Street Global. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. There will be another attempt to save the landmark Iran nuclear deal. Diplomats from Iran, the US and Europe will meet again in Vienna after months of deadlock. The accord fell apart after Donald Trump withdrew 4 years ago and reimposed sanctions on the Iranian economy. That led Iran to step up enrichment of uranium. The US Senate has voted overwhelmingly to add Finland and Sweden to NATO. It's a move aimed at bolstering the military alliance after Russia's invasion of Ukraine. Turkey is still threatening to block the two countries from joining. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees. It's trying to move back to profitability after losses and scandals. And shares of Alibaba are rising in pre-market trading. The Chinese e-commerce giant posted second quarter net income and revenue that were better than expected. Alibaba's cloud and media sales missed estimates, whilst sales at the China commerce segment shrank for the first time. The company says it saw signs of recovery in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
the standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top end venture is sort of 3x net of fees. Ideally you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe to 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digeon Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question. Great question. Great question. Great question. Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We only have about a 5 to 10% risk max that the Chinese and the U.S. will come to blows militarily. And if it happened, it would probably be inadvertent. We don't think Beijing or Washington want to have a military conflict here, any kind of an incident.
Robert McNally there on the situation over in China and beyond. From New York City this morning, good morning. Tom Keene, Lisa Bramis and Jonathan Ferro. Futures positive 2/10 on the S&P. The rally continues on the NASDAQ, up around about a quarter, call it a third of 1% higher. Yields a little bit higher on a US 10-year, a Treasury, by a basis point to 271.18. They are lower on a British 10-year, a gilt 10-year yield, lower, much lower. Look at this for a forecast. Can you imagine? You've got to hike 50 basis points. You're forecasting inflation to hit 13% and recession to start at the end of the year, Tom. That was the Bank of England 20 minutes ago.
We've certainly never seen that from the Fed. I mean, it's absolutely original. John, place in context right now how the two candidates will adapt and adjust to what we saw at 7:00. What will Truss and Sunak listen for in the press conference?
There is going to be a ton of pressure now, Tom, for them to do more on the fiscal side. And ultimately, that's what they're trying to do, if you're Liz Truss. Rishi Sunak, the former Chancellor, is essentially saying we've got to get the finances in order first. And ultimately, Tom, the more they do perhaps on the fiscal side, the more the Bank of England might have to lean in too.
Exactly.
Given what could happen with inflation.
A vicious circle.
And this is what Lizzie Burden said at the top of the programme as we broke down this decision. It's very hard to understand these forecasts without really knowing, Tom, what the fiscal picture will look like down in London and Westminster.
To our American audience on radio and TV, I really can't convey the differences here. The similarities are way overrated. There are differences and similarities with China and Washington. Jack Fitzpatrick joins, picking up the pieces on a Thursday after an historic week, and the week is not ended. Jack, I've taken a lot of solace from Foreign Affairs magazine. Richard Haas and David Sachs lead there with the response that we must have that is unambiguous. What clarity should we listen for from President Biden?
As it relates to the recent Taiwan trip in China, I think that there's been a lot of ambiguity, and the White House may even be leaning in a bit to some ambiguity because on one hand, you have the Speaker of the House visiting Taiwan despite warnings from the Chinese government. And yes, the U.S. has a close relationship with Taiwan, but you see, for example, the White House pushing back a bit, at least on the timing of a bill that was supposed to come up to formally treat Taiwan as a non-NATO ally. The Biden administration has said openly that the military had some concerns about Pelosi making this trip. They aren't going to openly fight her on that, but there is quite a bit of ambiguity, and it has put President Biden in a position where he wants to have communication with the Chinese side, but not entirely try to back off of the relationship with Taiwan.
Should we expect an announcement from Washington and Beijing over a meeting of the two parties?
I don't know about an announcement on a meeting of the two parties. There was the phone call recently, and obviously the White House doesn't want to cut off communications with the Chinese government. We'll have to see where the White House goes in the future, but they've made it a priority to have direct communication between President Biden and Xi Jinping, and have felt that's particularly important given the tension with Speaker Pelosi's visit.
It's a difficult time for President Biden's camp, especially because of all of the other issues domestically that are facing and what's coming down the pike. I'm wondering about what you're hearing about messaging ahead of tomorrow's jobs report. If it's strong, great, the economy is doing well, but not so great because that means the Fed will have to do more weakening, and all of a sudden people accuse President Biden of overseeing an economy heading for recession. How are they trying to get ahead of that?
Well, either way, the White House is not trying to message in a way on the economy that takes for granted some level of success on the economy. They've really lately been focused on acknowledging concerns about inflation. You see essentially the rebranding of their legislative proposals, or what they could get into the Inflation Reduction Act, as they're calling it, trying to focus on deficit reduction issues. So they even if the news is good, they're not exactly taking a victory lap on the economy. The president is talking about what he's trying to do with members of Congress to address inflation, and it's much more of a tone of conceding that there are significant issues, that this is not an economy that's going to be a huge success electorally for the Democrats in the midterms, but trying to make the case that they're doing what they can about it.
Hey, Jack, awesome to catch up. Jack Fitzpatrick there of Bloomberg Government down in Washington, D.C. Lisa, it's never easy, is it? It is never easy to get a bill together and get everyone on board.
Especially now when you have that much splintering within each party, let alone the dual parties. How much do you get people coalescing around a deal that really came together shockingly quickly and shockingly quietly, if you think about it? This is the stripped down, Build Back Better, rebranded as the Inflation Relief Act of 2022 that they're trying to push through.
Does it actually reduce inflation? And that's something we can talk about another time. Tom, no room for error, no space for error at all in that Senate for these Democrats.
Well, that's true. And again, this goes back to the heart of the matter, which is a victory that we saw in, 2020. And it's been a struggle the entire way and still continues to be a struggle domestically. And as we were talking to Jack there, John, I'm fascinated about the cohesive message to China into Q4. That doesn't even mention the COVID debate, which is still very tangible.
That's the number one debate, Tom. COVID zero. Paul Sankey talked about it moments ago, about an hour ago on this program. Lisa, can you have a complete picture of the oil market next year without understanding whether we've got COVID zero in China, lockdown, lock off? What is it?
Can you have a coherent understanding of the global economy, of trade? And we get those trade numbers at 8:30 in about an hour from the United States. Can you get any picture without understanding China's zero COVID policy, particularly with the energy market? And then how does this factor in to where the U.S. sees its leverage at a time of ratcheting up conflict between the U.S. and China?
I mean, John, I'm going to go back to your relationship on one of your other properties with Jay Pulaski. He won't get up early enough to talk to us. He will talk to you in a later decent morning hour, and it's about a Pacific Rim recovery. And the JP Morgan oil call folds right into a demand recovery off of emerging markets in Pacific Rim. It's not happening.
It's kind of you just to say that Jay only comes on because he likes to sleep longer, Tom.
That is. It's like same with Mohammed.
What a great compliment to my team.
You know, Ilarian's the same thing.
Just Mohammed likes to sleep in too. That's the only reason he comes on with me as well.
Yeah.
Thanks. I appreciate that,
Things
Tom.
are great between you guys this morning.
No love lost today, hey?
I'm going to call Dr. Phil. I think
I'm still reeling from these forecasts over on Threadneedle Street at the Bank of England.
Truly stunning.
Recessions in the forecast for 4Q, 13% CPI. Brutal, Tom, brutal.
What about sterling?
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
When Big Tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they're not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Face of so much doubt, what a rally we've seen on the S&P, on the Nasdaq since the June 16th low. On the Nasdaq 100 up more than 19%. On the S&P 500 up more than 13%. Right now futures positive by a little more than 1/10% on the S&P. On the Nasdaq 100 up around 0.2%. You saw the bond market yesterday, how it responded to the Fed speak. Yields higher at the front end, but a drop at the long end. And the curve inversion, 2s versus 10s, getting close to negative 40 basis points at one point this morning. Right now, yields up again by 3 basis points on a 10-year, up only a basis point or so on a 10-year. So again, a little bit more curve flattening, a little bit more inversion. In the UK, about 30 minutes ago.
The hands again, John. The hands is very good.
That's the Tom Cruise thing.
On radio, it was great.
Impossible, the inversion thing anyway.
You look like you're landing an airplane.
Can I do the UK thing first?
Please.
Tom? We got some inversion briefly for a moment on 2s versus 10s on the gilt curve about 30 minutes ago off the back of the Bank of England rate decision. The Y got a 50 basis point hike, and the Bank of England forecasting a recession in Q4 that lasts the whole of 2023. Tom, throw in 13% CPI, stir it up, and what have you got? Pretty brutal.
Do you have John Major? John, with all your perspective at Warwick and history, are we reduxing 91 into 92?
We will find out what the fiscal response will be from the next Prime Minister, which we expect it will be Liz Truss, Tom, based on the betting at the moment and where things are leaning. And if it's Liz Truss and she does more, Tom, I just wonder where that leaves the Bank of England. Do they have to do more? And Tom, you know what came after Major? Ultimately, what we got in Gordon Brown and Tony Blair was an independent central bank. Since we had an independent central bank,
there you go.
This is the biggest hike since then.
See, folks, that's your value add on surveillance.
That's your lot. You should just turn down a radio, change the channel and move on, because from here, downhill. In fact, from here it gets better because Lisa speaks and Tom and I stop talking. Futures, positive. Let's get some stocks. Here's Bramo. Hey, Lisa.
Hey, I hope I can deliver on that. There are a lot of really interesting stories that go beyond the macro, and there are these micro currents. Alibaba among them. American depository receipts up almost 5% after being down about 20% year to date. They beat expectations just in their earnings, despite all of the headwinds, despite the zero COVID policy, despite regulatory oversight and crackdowns by the authorities there. Taiwan Semiconductor, I'm watching closely, up about 0.8% after we talked about Nancy Pelosi visiting the island and meeting actually with executives from the Taiwan Semiconductor Company, which is such a pivotal node in the entire global ecosystem, considering how much of our world depends on chips, that they are the major provider of them. Lyft, I'm watching closely. Those shares down about 60% year to date. They're up about 0.8%. They're reporting after the bell. Some of the other stories that are less positive today, based on some of the earnings outlooks. Clorox came out, disappointing earnings, down about 6% ahead of the open. This is a story about supply chains. It is more vulnerable to them at a time when people are demanding prices not rise that much. You are getting consumer pushback to some of the price increases. Eli Lilly came out. They talked about headwinds from the FX currents, about $400 million off their top line based on that. Those shares down about 3%. And then Lucid Group poised to report earnings. They were talking about the forecast going forward. They halved their output expectations for 2022. The electric vehicle maker already down sharply year to date, down about 13% now ahead of the market. And Tom, the reason why these kinds of stories are interesting is because some stocks were bid up so dramatically after
after the pandemic or during the pandemic have come full circle. We have seen completely the wind knocked out of so many companies with most of the value taken out. And that is underpinning some of the ballasts of the market that have held in much better.
Futures of fate, the VIX under a stunning 22, 21.88 is really quite something here, less than an hour from jobless claims. This is a joy right now to be briefed in the chaos of this early August. Ed Al-Husseini joins us to say senior interest rate strategist at Columbia Threadneedle barely describes the legit EM World Bank IMF cred that he brings, this out of Colgate University and a small college in Cambridge as well. Good morning. I want to go to your real job before you got this act at Columbia Threadneedle, which is at Moody's. You actually sat at a desk in rated EM. Are we heading towards what you and I studied in history of EM next year in 2023? How fragile is EM?
Yeah, it's a good question. I think there's a really long tail in emerging markets that is in distress. And we're seeing that in South Asia. We're seeing that in sub-Saharan Africa. The good news is the core of EM, the emerging markets that went through those crises in the 2000s, in the 90s, they've built up much better buffers.
They've got better practices now.
They've got better practice, better policy.
I look at this, let's bring it over to developed country. In the headline here, John's been wonderful on it. It's the shock and awe of 13.2% inflation. Can you explain to me almost the first derivative of the x-axis we're all going to live on this inflation battle? We're all thinking short-term quarters and that it's a media thing. Are you looking at 1, 2, and 3 years for inflation to come in?
I think that's right. If you think about the challenge for central banks, I mean, both the Fed and the Bank of England is, of course, in a much more difficult spot, is the ability to build confidence that inflation will go back down to 2% over the next several years is exceptionally low right now. So what happens to the data over the next several quarters, in some ways, is a lot less important than those central banks' ability to be confident that they've tipped inflation over on a trajectory down to 2%. It's very, very difficult to get to that spot at this stage.
Ed, we were talking earlier this morning with the Bank of England. They came out and they project a recession that is long, that is painful, at the same time that they're raising rates. Could the Fed ever do that?
I think the answer's got to be yes. They're definitely committed to their credibility. They're committed to reestablishing credibility with respect to the 2% target, and they're in a corner where they essentially must hike and must tighten policy if they don't see inflation coming down to 2%. So there's very little reason to doubt them at this stage.
So what's the market getting wrong? Because the market seems to be thinking the Fed will be able to move away from some of their rate hiking sooner than previously thought, even with the recent repricing, because there is this entrenched belief that inflation will come down in the next couple of quarters.
It's probably a decent bet that inflation will come down. It's not clear if it will come down to 2%, and that's the key benchmark. If you look at market pricing, markets are priced for about 100 basis points of tightening over the next 4 to 5 meetings. That's an exceptionally narrow room for the Fed to maneuver. And so if anything, you're starting to see the Fed come out and start to push back a little bit against that, just to create space for them to maneuver if data surprises them again in the course of the next couple of quarters.
I guess I'm trying to understand some of the movements in the market, because yes, you have seen people expecting inflation to roll over, perhaps not as much as the biggest optimists. You're also seeing credit rally at a dramatic pace. You're seeing people pile in at a time when there is the expectation that at some point there will be a downturn, if not an outright recession. Does this seem like a faulty bet or one that's worth piling into based on how high yields got?
It's tricky because I think two things are true. First, if you look at growth and growth expectations, you can probably make the case that perhaps they got too negative in the course of the past couple of months. So we've hit a little bit of a floor in terms of growth. Data has surprised marginally to the upside since then. And so you see that kind of a relief rally in credit and risk more broadly. At the same time, it's clear that the Fed is not done. Tighter financial conditions are essentially a precondition for inflation coming down to 2%. So the foundation for the risk rally is, I would say, quite thin.
I want to go to Benjamin Friedman. I want to take the synthesis of all your academics and the work you did at Harvard and the great, great Benjamin Friedman in his worry about sustained growth. In the jumble that we're in 2022, Is global growth at risk? Is this modern experiment of 6% China, decent growth in America, all the turmoil about inflation and that, is growth finally at risk?
I think it's a really good question. If you look at what's happening on the demographic side, we've been slowing progressively, really over the course of the past several decades. China's population is set to slow. Birth rates in the U.S. are exceptionally low.
But what about the technological overlay?
The productivity is the key question. If you look at productivity of the last several years, it's been very disappointing. Productivity growth over the last several years is flat to negative this year. So unless there's a recovery in productivity, which is a significant question mark, I think long-run growth is likely to perhaps take a step down. And again, from an interest rate perspective, it creates a challenging environment because it's becoming more likely that interest rates go back to that secular stagnation, low demand, high savings place yet again once we're through this inflation window.
I just want to get that in, John, for our August gloom theme, August doubt theme.
Is that what it is, Tom?
That was it. You were just trying to maintain the theme.
Just climbing the wall of doubt.
He's got some real authority there, seriously.
Ed does,
yeah,
without a doubt. Ed, thank you. Ed Al-Husseini there of Columbia Threadneedle Investments. Just a mention of high yield. In a month, we've tightened 140 basis points, Lisa, in a single month. Wow. Typically, you'd think that happens after the Fed has made a major pivot. They have not made a major pivot, in the words of the central bank speakers themselves.
Yeah, I was actually speaking with Howard Marks of Oaktree about this, and he was, before that rally, thought that there was a good buy, and after that rally said the risk-reward is pretty evenly balanced at this point. I mean, it's completely repriced things, and you've seen people respond and companies respond by selling a whole load of debt because get in while you can, right? And that's certainly what we're seeing right now.
I love how careful Howard is with his words. The risk reward. What did he say? The risk reward what?
Well, you basically was saying it seems like a balanced risk.
Okay.
And it seemed like it was a less balanced risk to the upside before that.
And there you go, Tom.
He never comes on with us.
Some serious spread timing.
John,
are you suggesting that he likes to sleep in too, Tom?
Yeah, we got to get Mr. Marks in here.
Is this your excuse for why people don't want to talk to you?
Yeah.
They want to stay in bed.
We could get Mohammed and Howard on together. That would be great.
That would be very cool.
Bring Ed Al-Husseini along. It'd be great.
That would be very cool.
All of us at a big table,
Yeah. In the same room?
Yeah.
That would be nice.
Over in Cambridge, road trip. Go see Mohammed.
Is it Mohammed's Got Tang?
I love this.
No, I don't.
How did you get a road trip in here?
Never say it is
Every
the university
single opportunity.
I know, it's not even an
That's
opportunity.
right, Tom. That's right. We'd be in a different time zone. That would change everything.
It would.
Then all these people would come on with you.
They would.
Futures on the S&P up 0.2 to 1%. I'm on board with that, Tom.
Really?
Just for a quarter or for the year?
Oh, no, move.
Oh, no,
like
for good.
Move.
Move.
Take vet bill,
okay.
take kennel fee, move.
We're gone. Okay. All right. At least has got to talk to her sons about that. See what they say.
Sure.
They're ready to go. Okay. All right. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. In the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in the race to become Prime Minister. Truss is just receiving the backing of former Chancellor Sajid Javid. That's a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Wall Street CEOs don't want to spend any time in quarantine if they attend a Hong Kong conference in November. The conference is designed to advertise the financial hub's revival after more than 2 years of COVID restrictions. The CEOs of Morgan Stanley, Goldman Sachs and UBS are amongst those invited. Their banks want a guarantee of quarantine-free travel. And investment banking bonuses on Wall Street are likely to plunge this year, according to compensation consultant Johnson Associates. Incentive pay for those underwriting debt and equity could plunge more than 45%. Those advising on mergers and acquisitions could see their bonuses fall by 1/4. At the 5 largest Wall Street firms, investment banking revenue fell 43% in the first 6 months of the year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully. And, the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
I think that the big issue we have in the market is that the Fed is not about to pivot. And it's the same issue we have for many central banks around the world, right? Inflation is so high that it's just too early for central banks to come out and explicitly signal something new.
Jens Nordvig there, Exante data. We're getting something new from the Bank of England, a 50 basis point hike. We haven't seen one of them for 27 years. Futures right now on the S&P are up a little more than 1/10%. The Nasdaq still rallying, up 0.2%. Your euro, unchanged, 101.69.
Look at sterling.
Yields up a basis point, 270.137. We can look at sterling right now, Tom. Negative 0.5 basis point on cable. Sterling against the US dollar, 120.85. Wow. They are forecasting a recession. They're forecasting CPI at 13% at its peak, Tom. And this is going to get really, really messy and difficult for the British consumer, that's for sure.
Let's get right to it. Our conversation of the day on the United Kingdom with David Blanchflower, professor of economics at Dartmouth College. He darkened the door at the Bank of England a number of years ago. We're thrilled he could join us today. Danny, you've gone through the details, and you make it very clear that a la 1947, in a path to the Eisenhower deflation, the inflation panic is overwrought. This is a bank signaling a deflation or a substantial disinflation out to 2024. What should be policy if we model a future disinflation?
Well, obviously, the story is the forecast of a recession. 6 quarters of negative growth they're forecasting. But if you go to I think it's their chart 1.4, and what you see there is that there's a significant risk in 2024 of deflation. And there's the famous chart the Bank of England produces, shows you 800 years of inflation. And the one thing that stands out from it is the big risk when you have high inflation is that you generate deflation. And so that's obviously the worry. I mean, the truth is, John is right. They're forecasting 13% inflation pretty soon this year, but by 2024, this thing plummets. And I think the likelihood is actually that this forecast is overly optimistic. I think the chances are the unemployment rate is going to rise by much more. Output is probably, I mean, it may not last for 6 quarters, but output probably is going to be weaker. And we're probably going to see the bank having to U-turn pretty fast. I mean, this is a devastating, terrible forecast. I'm sorry, last point. I remember in 2008 in August, so a number of reports ago, and the big deal then was the UK was in recession, and they didn't use the word recession. The word recession is all over this report. So this is devastating. But I think the argument that balance of risks is balanced, Lisa just talked about it, risks are actually very strongly to the downside to this. So why they actually raise rates, sort of unclear when you read the thing.
Well, Danny, let's talk about how original this moment truly is. And can you imagine the Federal Reserve forecasting a recession in the way that the Bank of England has done today? And why do you think that's the case?
Well, I think in some ways they're under huge political pressure to try and deal with the interest rate, with the inflation rate story. I mean, Truss came out this morning and said the bank should have raised rates earlier, and we're going to relook at the remit. So I think the politics of it are pretty interesting. I mean, the fact that the word recession is in this report. I don't know of any other monetary policy report that has that word. As I said, go back to the August 2008. They didn't even use the word recession when they were in recession. So obviously some of the question is, how quickly does recession come, and how quickly does the bad data come? But we've got bad PMIs this morning, sales of UK cars down 11%. I mean, this baby could get bad pretty quickly. And I think, as you say, the likelihood of the Fed doing this is really pretty different. But I think this is pretty unique for the MPC. I've not seen anything like this in all my time Bank of England watching.
When you're talking about the balance of risks and how it's incredibly skewed to the downside, how do you then respond to Jordan Rochester's point about a wage spiral that you're actually starting to see in a very real way, and how this bank gets ahead of that to curtail that, even if it requires some sort of recession or significant downside in the near term?
Well, we've been talking about non-existent wage spiral since 2008, which we haven't seen. I mean, we've seen some attempt to try and keep up nominal wage growth. We've seen big falls in real wages. I think the idea of a wage price spiral in the United States and in the UK is for the birds. I mean, we're seeing settlements around 4%. We're seeing public sector workers saying, we need to try and maintain our living standards. The chance that any of this is driven by workers demanding and getting higher wage increases, I see absolutely none of that. None of it in the United States, none of it in Europe, none of it in the UK. We're talking about 13% inflation and workers asking for 4% pay raises. This is not driven, none of this is driven by wages. So I think that whole argument is just nonsense.
Danny, a lot of people are saying that right now this is the Bank of England front-loading rate hikes, that they're going to start cutting rates, or at least pausing the rate hikes later this year, then cutting next year. And that seems to be this belief with the Fed as well, that yes, there are some pretty significant rate hikes, but it is a front-loading to try to get ahead of the inflationary push. Why do you think that's a bad idea, to see what you can do now and then wait and then see how it trickles out?
Lisa, it's a great point. But I mean, I always had the view that you say what we need to do is get rates up to try and cut them later from the recession that you've caused. So obviously that seems like a problem. I mean, the bigger issue in some sense, Lisa, is that, yes, you've now got rates up. We're talking globally around 2 or something, less in the euro area. The problem actually is, think back to 2008, we could cut from 5% to a half or 0. The room for the central bank to cut is limited. It's going to fall on fiscal authorities. Look in the UK. There's basically no prime minister. There's no chancellor of the exchequer. People are talking about the plans that they might have, but the pressure is going to come on a new chancellor and a new prime minister pretty darn quickly, and the markets are going to speak, and they're going to say whether they think this is appropriate or not. I mean, we don't even know who the chancellor would be in September when these bad data come in. So I agree with you, but it looks to me that you front load interest rate rises for the recession that you worsened by doing it. So I think there was a significant argument today to actually sit pat and wait, because it's unclear that these rate rises are going to do anything to bring inflation down, being caused by global oil prices. How is these interest rates actually going to do anything other than tank the economy? How do they actually bring prices down? And Bailey's already admitted that basically it can't. So I think there was a strong argument to sit, wait and watch, but the political argument was a very strong one, because the trust was threatening the remit of the banks, and they should have raised rates earlier.
Well, I'm not surprised you said that at the end there, Danny. That's for sure. Danny Blanchflower. Danny, always good to catch up from Dartmouth College. Governor Bailey saying this moments ago: our forecasts are, quote, exceptionally large. The risks around them. The risks around our forecasts are, quote, exceptionally large, Tom. And I think that probably holds true for most forecasts looking out anything beyond 3 months at the moment.
I was going to say 3 weeks. I mean, can we get to the November Fed meeting? I don't think so. Not a chance. We have to focus on the data, including August 10th, John, to September.
Inflation data next week here in the United States with Tom Keene and Lisa Abravitz. I'm Jonathan Ferro. Futures are up 0.1% from New York City. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The market is kind of looking through what the Fed and other central banks are saying right now.
I think the Fed's been trying to reset and say, hey guys, we didn't really pivot. You may have thought that, but we didn't do it.
It is possible to cool the labor market and cool the economy without seeing a real large increase in unemployment rate.
We're going to be disinflation. We're going to go through disinflation in the future. Now, I can't tell you when it's going to happen.
We wouldn't be particularly aggressive at this point, and we're just suggesting patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. A most momentous Thursday into the jobs report tomorrow. Claims in this hour, but all eyes on the United Kingdom. There's no other way to put it, John. History made this morning as Governor Bailey speaks now.
What an original moment, Tom, to see a central bank forecast the recession that starts in 4Q and goes through the whole of next year, together with 13% inflation and a 50 basis point rate hike. That's a pretty original moment, Tom.
27 years back, I go back to 1995, John. You remember it, John Major as prime minister coming off the 1992 chaos. John, that was when Arsenal, they acquired Inter Milan's Dennis Bergkamp. That was really something to see.
How do you remember that? I don't
remember it,
that.
but I looked it up because I remember this was incredible trade between Inter Milan and Arsenal back then. But it harkens back, John, seriously, not to the success he had at Arsenal, but I'm only doing this for Kit Jukes.
Sure.
The reason, John, is it harkens back to that early 90s uncertainty. Do you sense that uncertainty now in your England?
Without a doubt. And Tom, I'd go further. You have to recognize this is the biggest rate hike from this central bank since it became independent. And independence of the Bank of England, Tom, isn't that old? It's the late 90s.
Yes.
I think people forget that. And Tom, you remember the story of the last 10 years? We were talking about this independent central bank story, how credible they've been at keeping inflation down. That's changed over the last year. And there's some political pressure building on both the Bank of England and, for that matter, this Federal Reserve too.
And John, moments ago, this is the headline we've been waiting for. The governor saying not for the independent Bank of England to get involved in leadership election. Baloney, they did this morning.
And Tom, we'll find out if it is Liz Truss, and if it is Liz Truss, whether she comes out with a bigger fiscal package. That's what this market at the moment is very focused on when it comes to the UK. How big is the fiscal effort, and what does that mean for the Bank of England offset that might come down the road?
Sterling weaker here, 120.85. When we go to the bond market, Lisa Abramowitz, it's real simple. Fixed income speaks.
Fixed income is speaking, and it's not speaking in a very nice way. And honestly, stocks have taken notice as well. You've seen a lot of the gains in the early morning fade substantially. They're coming back a little bit, but it basically was a flat tape just moments ago. Bond yields coming down. How much is this in anticipation of the weakness that people are expecting from the moves that the central banks are going to make? And I look at the curve inversion, which means 37 basis points. In other words, the 2-year yield was 37 basis points above the 10-year yield just moments ago, at a time when people look at that as a recession signal, and it really is flashing some red signs.
Well, we're going to have to see. Let's get to the data right away. We've got so much to talk about here this morning. John, I'm going to go to the continued equity lift that we see. It's somewhat off the radar given the macro news, but nevertheless a resiliency indicated by the VIX. 21.99.
What a rally we've had, up 19% from the lows on the Nasdaq 100, up 13% from the June lows on the S&P 500, and futures go again by about 0.1%. Yields unchanged on a 10-year, 269.91, with sub 270 on a 10-year. We add a little bit more weight onto the 2-year over the last couple of days, just a ton of hawkish Fed speak, disrupting the bond market, and as Lisa said many times over the last couple of days, doing very little to disrupt the flow into the equity market. On the Bank of England, Mohammed Al-Arian just out on Twitter writing this, Tom. The Bank of England continuing, quote, with what has been the most direct and honest commentary of any major central bank.
No question about that.
We have not heard this kind of commentary from anybody, Tom, in a central bank about how dire they think this outlook is.
And someone with that perspective, Lee Farage joins us now, head of macro strategy for North America at State Street Global Markets with decades of experience. Lee, I'm going to cut to the American chase for those on radio and TV. Can the angst of Governor Bailey migrate across the Atlantic and become the angst of Chairman Powell?
Oh, I think almost certainly. I mean, as you just mentioned, I think the Bank of England is being the most honest of the central banks. They're predicting a recession that will last for 5 quarters, so a prolonged recession. And yet they feel the need to hike by 50 basis points with more to come. That's the reality facing the central banks. And the Fed is still, we can avoid recession. We think we won't actually hit recession, a slowdown, but no recession. Come on. We're going to go into recession. Major economies are going to go into recession. If we're going to target inflation, we're going to bring inflation down. The squeeze on the consumer is significant. We're going into recession.
So why is consumer discretionary rallying this hard? This rally off the lows in June, Lee, is something else. It's up more than 20% on consumer discretionary on the S&P. Why?
Well, you've got a big split. I mean, as ever, you have a big split between sort of, income levels. So lower income levels are really, really struggling with this increase in inflation. A large proportion of their spending goes on food and energy, which is, the heart of much of the inflationary pressure. Consumer discretionary, if you're the higher end of the income spectrum, there's still savings. There's still excess savings from the pandemic, and those are now being spent. So consumer discretionary is more that sort of higher end. Consumer staples is that sort of that lower income end, and that's why you're seeing that divergence there.
Lee, have you already seen it priced in terms of the recession that people are predicting? And is the consumer discretionary perhaps responding to the other side of this cycle because people have gotten that far ahead?
Lisa, I don't think we're pricing in the recession that's coming. I mean, I think it's not going to be a deep recession in the same way as the financial crisis, but it's going to be prolonged. The Bank of England have told us that this morning, right? It's going to be a prolonged recession. This idea, we could have a technical recession, maybe a quarter or two. No, this could be a more drawn out, prolonged recession. I don't think that's priced in. So I think that's the sort of the divergence here. And you say, the massive rally we've seen over the last few weeks or so, that's not reflecting that risk. That's reflecting this soft landing. We've taken out the peak for Fed rate hikes. We're sort of looking at, okay, so, that does the slowdown in growth, does the job for the Fed. They don't need to hike as far. We have this little slowdown and off we go. It's cloud cuckoo land. That's not the way this is going to play out. It's going to be a much more prolonged recession than that.
So, Lee, as you've adjusted your view to become much more negative, how have you changed your allocations at a time when many people see the haven as still being longer-term U.S. bonds?
I think it still is. I mean, I think still. I mean, this is why the curve's inverted. I mean, you look at how inverted the curve is, as you mentioned, the most inverted since 2000. So forget the financial crisis, forget the pandemic. This is the most inverted since 2000. And that's the allocation. You want to be at the longer end. And then in terms of FX, it's the dollar. And this is why the dollar keeps rallying. The dollar's bounced, dollar weakened a little bit over the last few weeks, but it's coming back hard again now. And the Fed message is going to be clear, and that's going to lead to more dollar buying as well.
Lee, our audience has heard the same thing repeatedly over the last several weeks, and repeatedly we keep adding more weight to this rally. Lee, earlier this morning, Matt Kettner of HSBC put out a note, and he's with you. He's calling this dreamland, says it's wishful thinking. At the end, though, he goes through the risk factors around the view. What if we're wrong? Lee, what if you're wrong? What's the big risk factor around your view and whether this rally can continue?
The biggest risk factor around the negative view is actually that, and it would be a very positive development, and that is that the conflict in Ukraine comes to a rapid end. That leads to, reduction in the sanctions quite quickly, and therefore the inflationary pressures. We can all revise down our inflation forecast. We can revise down what we expect from the central banks. That would be the risk to the view. If it doesn't end soon, it's really hard to see how central banks are going to back off, how the data is going to get better. Look, we've had this from the Bank of England. I think this is a real bellwether moment with the first central bank really predicting a prolonged recession and saying, that's the way it's going to be. We're still hiking 50 basis points. I think that's a bellwether moment.
Hey, Lee, great to catch up. An important moment for sure for that central bank. Lee Ferridge there of State Street Global Markets. I mentioned Max Kettner over at HSBC. Here's the quote. For this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields. Goes on to say, but market pricing of risk assets is now very much out of line with our cyclical growth indicators. You guys have all heard that a million times. This is the conclusion. Where could we be wrong? If inflation does indeed surprise to the downside or growth stabilizes much more quickly, Tom, than we thought, then the recent rally in growth over value could continue. It continues just a little bit this morning.
The separation here, John, is like the Dallas trim mean of earlier this week, which was really quite inflammatory, or certainly what we've seen from Governor Bailey as he frames out the United Kingdom, versus those that see the goods disinflation, service sector maybe becoming quiescent, and then you easily get from, say, 9% down to 7% or 6%. The then what, to me, is a complete mystery.
So the thing I think about as I'm going through all these notes in the evening at the moment is just, Lisa, what if Marco's right? Marco Kolanovic over at JP Morgan, and what if this just continues? BNP Paribas put out an interesting note this week, and they talked about the crowding in effect. And we all know the biggest determinant of sentiment sometimes is just price. And price is changing pretty quickly. And I wonder if BNP has a point when it comes to crowding in.
And especially because if you take a look at the savings rate and you look at it across the income spectrum, at the upper ends, it still is very significant. There are a lot of people still with a lot of money who are getting pay raises and they don't know where to put it. And so where are they going to go if not just into the market? And you do see companies that are delivering on their revenues and are still growing. So at what point does that become a haven, especially in light of the inflation that might really affect some of the bonds that people are going to for safety?
John, you're going through your notes in the evening?
In the evening, what do you do?
I was watching Padres last night, 9-1,
you're always, someone's
5 in a row.
Someone's got to rate.
I'm reading.
Lita does a bit of your reading. I do a bit of your reading.
We put it together.
You know, it's just great.
You get to watch the baseball. Tom, is 8
it's not the
a.m. in the
baseball,
morning.
it's the Padres.
Is 8 a.m. in the morning late enough for great guests to come on this show? Are they out of bed at this point?
Yeah,
probably, right?
Probably entrepreneurial guys buying